The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to this absolutely pivotal edition of Squawk Box. I'm Steve Sedgwick and we're live from Cernobbio in Italy. And of course, Karen Cho in our London studio. These are your headlines. Wow, what a big piece of data. US employment data already, though, sending mixed messages as global equities tread water ahead of a crucial non-farm payrolls report later on. Well, 25 or 50, that's the question we're all asking, isn't it? Uncertainty looming. Traders placing bets on the Fed's next rate cut. The Nobel Laureate Joseph Stiglitz already has told me here in Ambrosetti that his mind is set regardless of today's payroll print.
I would vote for a bigger rate cut because I think they went too far, and it would actually help on the issue of inflation and on jobs.
OPEC-plus producers delay plans to hike oil production by at least 2 months as crude prices slump to their lowest levels this year. France appoints a prime minister after nearly 60 days of stalemate, with President Macron handing veteran conservative Michel Barnier the role. And Volvo CEO Jim Rowan tells CNBC the EV transition is taking more time than expected after the carmaker ditches plans to go fully electric by 2030.
That's really the biggest change, that we'll use more plug-in electric hybrid cars in the short term, and eventually we'll bridge to fully electric, but that will probably take a little bit longer than we first thought.
Karen, let's be brutally honest about it, and good morning to our viewers. Sometimes you and I end up travelling around Europe, travelling around the world, and we sometimes wonder, where's the news? What are we really following the news with our coverage here? Actually, that is not the case here at Ambrosetti. And honestly, I know that we say, oh, welcome to this place, it's great to be here. But already, I've had a brilliant couple of conversations. Valerio De Moli, the boss here of the European House Ambrosetti, we talked a lot about Europe, where it's going, where it's not going. I spoke to Joe Stiglitz, one of the greatest economic minds of many of the last few generations, and some great commentary on Trump, on payroll, on interest rates, on Kamala Harris as well, and we'll bring you as much of that sound as we can throughout the show. Plus, we're going to get balance from the other side. It's fair to say that Joe is centre-left. Well, we've got Neil Ferguson coming up later on as well. Later on in pre-recorded interview, I'm going to speak to one of the most important men in Saudi Arabia as well, Khalid Al-Fali as well, who's trying to get more investment into the country. I'm going to speak to Marcus Kerber as well, who is a key CDU advisor about what's going on in German politics as well. We're going to speak to Beata Jaworczyk as well from the EBRD about the green transition and what's going on in Ukraine. So I promise the viewers we will cover every single base with interviews over the next few hours here out of Ambrosetti. But there's no doubt about it, Karen. You're in the epicenter of the trader concerns. London, everyone looking. Is it going to be 25? Is it going to be 50? We often say the non-farm payroll is the mummy, the daddy of all the data as well. There's no doubt about it this time round, is there?
It's such a big macro day, and in fact, it's been a very big macro week. I think we got started very quickly with the ISM manufacturing news this week. We've got a market that is incredibly sensitive to any form of signal around a slowdown, and the ISM just setting the scene for this week. And I think the ADP yesterday also reinforcing the prospect that, look, we do have some slowing taking place. Just what the non-farm payroll presents later today in terms of the extent of that slowdown challenge is key. And it's interesting that you're talking about 50 basis points again there on the ground in Italy. We heard overnight from JP Morgan, one of the voices that spooked the markets around the prospect of a 50 basis point reduction being required, again doubling down on that possibility and that it may be required. So I think today, massive for markets, Steve. Well, let's get going as traders are bracing for key data releases ahead of this month's FOMC meeting, with August non-farm payrolls data due to cross the wires at 14:30 CET. Markets are penciling in an uptick of more than 160,000, with a slight decline in the unemployment rate to 4.2%, according to Dow Jones estimates. That's an increase of almost 50,000 on July. But recent data pointing to a faltering labour market and commentary to that effect from Fed officials has cast doubt on whether we'll see an increase of that scale. On Thursday, the ADP private payrolls report for August notched the smallest gain in more than 3.5 years at 99,000. Initial jobless claims, they came in just under 230,000, down slightly on July's figure. ADP Chief Economist Neela Richardson took CNBC through the latest figures.
After 2 years of outsized hiring and growth, we're finally seeing a normalization that's a little cooler than expected, cooler than average, slower hiring than we've seen in the past. And so taken together with other data, it's pointing to a softer labor market. We're not falling off a cliff. These are not job losses, but slower hiring, stable wage growth.
So this is how the market digested those ADP figures. You can see it was on the back foot, and the Dow in particular, don't forget this has been the area of rotation on the markets. So some days we've seen a bit more resilience in the Dow. Not the case yesterday, sliding by just over 0.5%, taking us down by about 200 plus points. A third coming off the S&P 500 that's been caught up with some of the technology selling. It's impacted the S&P 500. It's impacted the NASDAQ in particular this week. And while we saw a green print there yesterday, this is a market that has shed 3.3% over the trading week. So there's clearly been a very reactionary environment already on the data. To US futures, is this telling us the story? We're still waiting it out for the data. Don't forget the early picture this morning showing us a patch of green around the Dow. That's 30 odd points to the upside, but patches of red bookending this market. A little bit on the S&P 500, but a bit more on the NASDAQ. Let's just wait it out for the numbers on non-farm payroll, and then we'll get a closer indication, won't we, Steve?
We will, but I mean, look, not many people out there don't expect jobs to be created. Not many people think we're going to be far away from a 4.2% handle on the unemployment rate. Not many people are saying we're not going to get a 3% handle plus on the AHE, the average hourly earnings. So it's kind of still pretty good compared with some of the episodes of unemployment that you and I have witnessed over our careers. But money markets are split. 60-40 in favour of a quarter point cut at the next meeting. 60-40, it's tight now, isn't it? Expectations of a 50 basis point reduction are down by more than a half on last month. Now that's according to the CME's Fed Watch tool. I spoke with the economist and Nobel Laureate Joseph Stiglitz here at the Ambrosetti Forum on arrival. He was very generous with his time. We talked about a lot of issues, a lot of politics. We'll come to that a little bit later on as well. And I asked whether the Fed's independence, of course, could potentially be at risk under a Trump presidency.
I've been criticizing the Fed for going too far too fast. Really important for it to have normalized interest rates. Zero interest rate is not the cost of capital. And so that was a mistake probably to have it that low, that long since 2008. But then they went beyond that to where the interest rates have been. And I thought that put the economy at risk for very little benefit, probably actually worsening inflation, ironically, because if you look more carefully at the sources of inflation, a big component was housing. If you think about how do we deal with the problem of a housing shortage, which is increasing the price of inflation, do you think raising interest rates, making it more difficult for real estate developers to build more houses, homeowners to buy more houses, is going to solve the housing shortage? No, it's going in exactly the wrong way. So I believe that they have contributed to the problem of inflation. Now, even though their models don't work this way, and they're not looking at things, I think, as deeply as they should, their models tell them, look at the weaknesses in the economy, and therefore we should be lowering interest rates. So I would vote for a bigger rate cut because I think they went too far, and it would actually help on the issue of inflation and on jobs.
So on the 17th and 18th of September, regardless of the payroll figure later on Friday, you think 50 basis points should be on the table?
Yes.
And I think that's a really interesting perspective. And it's almost the polar opposite of some of the conversations we had because, Karen, everyone says we're data-driven. The Fed says we're data-driven. Every single one of those dozens of Fed speakers that we've heard on CNBC, that we've spoken to, that you've spoken to as well, they say that we're data-driven, but that's not always the case. It's actually the actions of the Federal Reserve are often driving the inflationary picture. Now, we often hear the other side of things. Well, if you lower too soon, you're going to ignite animal spirits, which is going to create more inflation. What Joe Stiglitz is arguing there, and I think it's very interesting, is no, by not cutting, they are creating more inflation because of the housing market, because that is at the core, of course, for the consumer. It's the key issue for them, the mortgage rates, the housing availability, the housing build. And by keeping rates higher for longer, you're actually preventing barriers to the affordability, to the creation of more home property as well. So I think it's a really interesting debate. It's an economic debate. It's a real debate as well, that not only is the Fed watching the data, but the Fed's actions themselves are either creating more inflation by staying where they are, or more inflation if they cut too aggressively, according to others as well. It's a delicious equation, Karen.
Supply and demand, one of the fundamentals of economics, and we're hearing that through Joseph Stiglitz. Always a real pleasure to listen to him. He was in my economic books when I was studying economics. But I think what's interesting to hear this pendulum argument that perhaps we swung too far one way. We need to swing a little bit further back the other way with interest rate cuts. And this is something that JP Morgan's top economist was talking about, saying, look, if you look at the neutral rate, roughly we think about 4%, or about 150 odd basis points off that. So if you think that the interest rates are going to take about 1 year to come through the system, this is what economists think. You see the Fed cutting this month, about a year later you see the impact on the economy. If you already think that the Fed is behind the curve and that we're too far off the neutral rate, then the Fed's got to get going. There is a view that it should front load the rate cuts with a 50 basis point reduction. The problem here is the optics, and in the past when we've seen a reduction of that magnitude, it does suggest that there's something ailing the economy. And we keep hearing from a number of commentators that if the Fed were to reduce by 50 basis points, it would send very negative signals to a market. And let's face it, this is a market that's extremely sensitive to any bad news that it thinks it doesn't know about. So perhaps 50 basis points, would it undermine some of the market confidence that remains at this stage? I think that's very fascinating to see, because we've had a market event in August. The market sold off on fears that perhaps there was some sort of economic slowdown, that a soft landing was not in the bag. And then we've seen it again this month. So would 50 basis points do the trick or not? And is it slow as it goes, but reinforce the reductions with 25 basis point moves at every single meeting that the Fed has until the end of this year? I think that is going to be very closely watched by the markets. The other next stop too is going to be, let's face it, when it comes to jobs, it'll be wages. And this is something that Neela Richardson from ADP was pointing out yesterday. We all know that a slowdown is now happening in the jobs market, but how is it impacting wages? And that wage price spiral has been really key for the Fed, where wages have gone up. It's added to inflationary pressures. They've really struggled to get a handle on that. Is that starting to abate? And to what extent are those wage pressures coming off now, Steve?
Yeah, and I would agree with you to a point, but I want to make it a little bit more 3D and come into your speciality, Karen. Technology. Look, this market event, both market events, the one at the start of August and the one we've had a little bit this week, where the S&P is having apparently its worst week since April, down 2.6%. But both of those have been about very specific issues as well, about technology, about valuations, about liquidity, about market positioning. So I actually kind of almost coming back on what I normally say and saying, this isn't just about the Fed, what happened with that market event. I think it's very much about other factors as well. But you and I have debated this extensively, and will do over the next 2 hours and 47 minutes on Squawk Box as well. The other key issue, which all of us are, well, I think we're excited about, we're all excited about the US election, aren't we? And what's going on there? Well, as you'd expect, Joe Stiglitz is no fan of Donald Trump, and I'm sure it's pretty mutual as well. The Republican presidential candidate, Donald Trump, really interesting. Did you all see what he said in New York last night? I thought it was fascinating. He set out a plan to lower taxes and regulation and boost energy production, which he says will lift growth and tackle inflation. There was a lot in there as well. It needs a lot of digesting as well. I thought it was fascinating. He was speaking at the Economic Club of New York. Now, Mr. Trump also backed plans for a government efficiency commission led by, here he is again, you can't keep him out of the news, ex-CEO Elon Musk. I know. Has the man not got enough jobs? Has he got more time on his hands? I find it extraordinary. Anyway, ex-CEO Elon Musk, that he says will recommend drastic reforms and another bonfire of the regulations. Well, I asked Joe Stiglitz how significant November's election will be for the US economy.
there are a number of initiatives to make our economy both more dynamic and, you might say, more affordable. So one important piece is there's been a large increase in market power, in concentration in our economy over the last 20 years, and we're finally, under Biden, beginning to attack that. There are some real bottlenecks in our economy. For some reason, and this is true in many European economies, housing prices have soared. And no one has really been able to give a comprehensive agenda to try to bring those prices down. And she's put forward a fairly comprehensive agenda to do that. And I think that will, I'm hopeful that that will be successful. On the issue of debt, which everything is obviously great on the curve as a teacher, and what I see is there's no comparison between the nature of the debt that will emerge if Trump is successful and Harris's. Trump has promised massive tax cuts for the corporations, large tax cuts for wealthy individuals. The magnitudes of the deficits that will result will be in the trillions of dollars. Several times the increase in deficits that will result from the kinds of proposals that Harris puts forward. So in my mind, even on the issue of deficits, there's no comparison.
Nobel Laureate Joe Stiglitz there, and we're going to have plenty more coverage from the, it is fair to say, tempestuous shores of Lake Como throughout the day here on CNBC, including interviews with more top economists and political figures. I've even got a US congressman for you who's a big Trump supporter. So lots coming out of political, academic, economic, corporate figures right from here in Como, Karen.
Steve, that Lake Como microclimate, a little bit like the markets at the moment, you get a little bit of everything. Now, ahead on the show, OPEC-plus delays production hikes as oil hits a 9-month low. We'll discuss that next. Plus, the wait is over. Macron has finally named a prime minister, bringing Brexit negotiator Michel Barnier back into the fold. We'll talk about that at the latest this hour. And as waning EV demand plagues automakers, we'll bring you an exclusive interview with Volvo Cars CEO Jim Rowan that is coming up at 7:40 CET.
Welcome back to Squawk Box. One thing that Mr. Trump also talked about last night was US energy independence, halving energy prices for Americans within 6 months, creating, would you believe, American energy, not just independence, dominance. Wow. What does that mean? What does that mean for OPEC-plus? Because OPEC-plus members now have delayed plans to hike production in October and November. Not because of what Trump said, just because of the economic reality at the moment. This after crude prices hit their lowest levels in 9 months. Now, the group had planned to hike output, of course, by 180,000 barrels a day. Dan joins us with more. Dan, you and I have had the privilege of following the oil markets for many, many years. We've been to dozens and dozens of OPEC meetings between us as well. I think both of us could have seen this one coming.
I think I would have to agree with you, Steve, and this should not be seen as such a significant surprise. What we've seen here is OPEC basically taking a pause, trying to catch a break after a week of relentless selling in oil. What we saw last night was the group agreeing essentially to delay their planned oil output increase for at least 2 months. But the headline really hasn't been enough to push oil out of a sharp weekly decline. What we saw was Saudi Arabia, Russia, the UAE and other top members of the group all coming together. They were due to unwind these voluntary output cuts from the start of October, but those cuts are now going to stay in place until December 1, effectively keeping about 180,000 barrels offline. As I mentioned, we shouldn't be too surprised by this decision. OPEC has the spare capacity to make these adjustments, and it does take a more active management role, an active management stance on the market right now. And the leadership has also consistently said that it would be precautious, proactive, and preemptive. And they have stressed as well in making this decision that they have the flexibility to pause or reverse the adjustments as necessary. So the ultimate question is, what does this mean for the market? And that said, one wonders whether this is really going to be enough to stem the market decline that we've seen over the last couple of weeks. The recent data from China and the United States has been flashing a demand warning signal, and at the same time, the headlines around supply increases from Libya have also been broadly bearish. OPEC is, of course, still planning to gradually unwind these voluntary cuts, but perhaps at a slower pace as the macroeconomic situation, the macroeconomic backdrop continues to develop.
Thank you very much for that, Dan. We appreciate the update. French President Emmanuel Macron has named the former Brexit negotiator Michel Barnier as the country's new Prime Minister. Barnier, who is a veteran of France's Conservative Labour Republican Party, promised to listen to and respect all political forces within a divided French National Assembly. Well, Charlotte joins us with more. Charlotte, my first question, is Macron now going to have his cake and eat it now that he's got Barnier in place?
Well, look, it's going to be an interesting one.
Certainly, a Brexit reference for those who missed it.
Certainly a surprise. You will need someone who has very good negotiation skills.
Exactly.
And certainly Michel Barnier has shown that he has that. And look, it was a surprise name. After all this week and so many rumors and names swirling around, this one started coming through a couple of days ago in the evening, saying that he could be the next Prime Minister. There was a bit of a surprise here for the fifth Prime Minister of Emmanuel Macron, and of course then finally him being picked, so 73-year-old. We're going from the youngest Prime Minister to the oldest Prime Minister of the Fifth Republic, and that's kind of a bit symbolic as well. Maybe there's a change of style and change of politics there, but look, there's no doubt that he has excellent reputation of seriousness. He, as you were saying, he knows the institutions inside out. He's been MP, he's been Minister 4 times, he's been EU Commissioner twice, of course, the most recent stint also as Brexit negotiator. So someone who's considered very, very serious and knows the institutions very well and has good negotiation skills, which once again might be extremely important. But someone that comes from Les Républicains, and there is a surprise there.
That's the right. So forgive me if I'm wrong, but wasn't it the left that was dominant the last election? How on earth have we now ended up with someone from the right?
Yeah, so the left came top, but by the numbers, it was clear that their candidate would be ousted by vote of no confidence. And so that's why Emmanuel Macron decided to pick a candidate that maybe would be able to get the votes and not be ousted straight away. And certainly, when you look overall at all the votes within the National Assembly, France voted to the right more than the left. The left-wing bloc came top, but certainly when you add all the votes, including from the Rassemblement National, well, the right has the majority. So we'll have to wait and see. Of course, he will have to reach out to some of the centre-left politicians to try and reach a majority before some on the left in particular say, look, you make the Rassemblement National the kingmaker in this situation. That's why there's been a lot of criticism. Maybe the main criticism here in naming Michel Barnier is that gives a lot of power to Marine Le Pen, and they're one that kind of hold the key there, whether he is ousted as Prime Minister or not. What kind of Prime Minister will he be? Well, we'll have to wait and see. Now he has to form his government, so that will be a tricky one as well. Who does he reach out to? Will he bring some left-wing politicians, some more technocratic profiles? We'll have to wait. But certainly what we can stand on is just his manifesto, because he stood to be a potential presidential candidate in France for Les Républicains. He did the primary, and in the primary, his program was actually particularly tough, particularly on immigration. And that's where we think maybe the negotiation with the Rassemblement National could be happening.
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabi Lekumete, weekdays on CNBC.